Hi, I'm Ernie Started, founder and president of Power Options. Power Options is an educational and tools site for self-directed investors who invest in stock option combinations. We are not a broker or advisor, just investors investing for our own accounts. This presentation is an introduction to options and part of our educational series. Let me give you a brief summary about my options background. I worked for the Hewlett-Packard Company for 30 plus years. During my employment, I acquired company stock and invested in a 401k, like many of you. After retirement, my mode of investing changed. Prior to retirement, I was interested in capital gains. However, after retirement, I was more interested in generating income to support myself. My choice of income generation was the use of covered calls to basically rent out my stock holdings for income. I will explain that income process further in this presentation. However, there were no tools available to help me in the covered call selections. Therefore, I developed those tools for myself. Once developed, friends and colleagues asked me if I would make them available on the internet. And bingo, Power Options was formed. But enough about me and the company. Let's get started and learn about options. The presentation will cover option basics. In this presentation, we will show several ways to use options and hopefully dispel the notion that options are too risky for the average investor. We will show several examples in the use of options and option strategies, and finish with a hedge methodology that will literally change your investing life. So, what is an option? An option or derivative gives the holder the right to buy or sell some asset at some point in time. An option is a contract to buy or sell consisting of three elements: the strike price, the agreed price for the asset; the expiration date, the time that the option is valid; and the market price, the fee paid for the option. There are two basic option types: the call option and the put option. A call option gives the holder the right to buy the asset or stock at a designated price for a specified period of time. The put option, on the other hand, gives the holder the right to sell the asset or stock at the designated price for a specific period of time. These two basic options can be used in many ways by an investor. At Power Options, we support over 23 plus combinations and strategies using these two basic elements. Let us go over an example of both a call and a put option. For our call example, we will use Apple stock, which was selling at $93.39 on February 18th. We can buy a call option, which will give us the right to buy 100 shares of Apple stock at $95 until March 18th, which is 1 month in the future, for a cost of $315 or $3.15 per share. Our three elements of the option are the strike price, or the right to buy at 95. We have a 1 month exercise period. By the way, most options are not really exercised. They are generally sold before they are exercised. And the last item would be that there is a fee associated with that 1 month buy, which is the $315 that it would cost us for the option. Just think about the financial leverage. We control $9,300 worth of Apple stock for a cost of only $315. That is a leverage of over 30 to 1. If Apple stock goes up 1 point, we potentially make $100 for a $300 investment. The profit loss curve for a typical call looks like is shown on this slide. This is a profit loss curve for a bought call. The profit loss is shown on the left axis versus the price of the stock on the bottom axis. As the stock rises above $95, the strike price, profits go up very quickly. If the stock stays below $95, there is a loss. The $315 that we paid for the call option is completely lost. Even if Apple stock goes to zero, however, we can only lose the cost of the option, or that original $315. Unlimited profits, but a limited loss. Now let us consider the put option. We will again use Apple as our example, but this time we'll buy a put. We can buy a put option, which will give us the right to sell 100 shares of Apple stock at $95 until March 18th, which is 1 month in the future, for a cost of $4.70 per share, or $470 for a contract of 100 shares. Our three elements again are the strike price, which gives us the right to sell at 95. We have 1 month to expiration for the option, 1 month to take advantage of this sale, and the fee for the 1 month right to sell our Apple at 95 is $470 per 100 shares. Now, if Apple declines 1 point, we can profit $100 for a $470 investment, or a potential of a 21% profit for a 1 point decline on a $470 investment. Again, the profit loss curve for a put is very similar to the previous curve, except for it goes up in the opposite direction. This curve is similar, except for now, if the stock declines under $95, there is a profit. And the loss occurs when Apple sells at prices above $95. Puts have a limited loss, which is the cost of the option, in this case $470, but the most that we can gain is $95 if Apple stock goes to zero. Options are very versatile and can be used in many ways in a portfolio. As an example, options can be used to speculate. In the case of the put and the call that we just went over, that would be a case of speculation where very high leverage was used. This type of speculation is what gives options a bad reputation, because you can make a great deal of money or lose it all. It is not too much different than gambling in a casino. On the other hand, options can be used to generate income. As you recall, that is what got me interested and started in the use of options through a strategy called covered calls. We will give you an example of covered calls next. And the third way in which options can be used is through hedging. By hedging, we mean insuring a stock position against a decline or a wide swing in price. This is an extremely powerful and less publicized option technique. People insure homes, cars, paintings, but what about stocks? Few people insure their stocks or 401k holdings. Some stock portfolios are worth hundreds of thousands, even millions of dollars, but without insurance. We will show you how to provide that insurance later, after our covered call example. So, what is a covered call, and how do we generate income from our stock holdings? Let us continue with our Apple example. Assume we own shares of Apple stock. We just retired and want to generate income from our holdings. Apple has only a small dividend of 2% per year, which is not much as an income stream. We would like to earn 10% a year on our stock assets. An approach to earn income on our stock is to rent out our stock for a fee. Instead of buying a call, we will sell a call. We can sell someone the right to buy our Apple stock at $95 for 1 month and collect $315 on the sale of the option. That is a basic covered call strategy. If our Apple stock is selling at $93.69, we can sell a call option for $315 for immediate income. This action obligates us to sell our shares for $95 until the 18th of March, and we receive a fee of $315 because we give someone that privilege. As long as the Apple stock stays under $95, our stock will not be sold to meet this obligation, and we would have earned the $315. The profit loss curve for a covered call can be seen on this slide. Generating a $315 income on our Apple stock is essentially a 3.5% return on the money invested. Doing this type of covered call right 3 or 4 times in the next year can easily generate a 10% return on our assets, which is one of our retirement goals. There are several observations to be made from this graph. Note that the most that can be earned from the basic covered call position is the $315 agreed to in the price of selling the option. If Apple declines, there is little protection. But that was true even if we did not sell a covered call. The position was not insured. Once the stock goes over 95, we may be obligated to sell out our stock for $95. However, if that happens, we not only make the $315, but we also have a small capital gain on the stock as it moved from $93.69 up to $95. And the return would then have increased to 4.9%. To summarize the pros and the cons of a covered call strategy, with covered calls, the upside stock gains are limited by the option sale. But there are management techniques that can be learned to roll the strike price up, which would help alleviate this problem. By far, the greatest risk in doing a covered call is the same as just owning the stock. That is, it is unprotected and may decline. If Apple declines even a few points, the income is negated by the loss in the price of the stock. But you would have still been better off than not doing the covered call at all. Choosing the strike price above or below the price of the stock can be used to control the risk reward. By selling the call under the price of the stock, you have less risk, but you may be forced to sell your stock. A strike price over the price of the stock, one can participate and get some price appreciation. Doing a covered call is a bullish to neutral strategy. You want the stock to go up or remain the same so the income can be kept. As we had noted, the two principal drawbacks with a covered call are 1, the limited upside because of our obligation to deliver the stock, and 2, the risk of a stock decline. Both problems, however, can be solved by hedging. By hedging, we mean the control of price variation and risk of loss, while leaving the upside open for gain, basically solving the two negative points for a covered call. Since the buying of a put guarantees a sale price, it is like buying insurance for your stock or 401k. If the stock price falls under the strike price of the put, you are protected from any further loss. Of course, there is a fee for the insurance, which is the cost of the put. That cost is the most complained reason for not buying this insurance. When I speak to investors, I often ask at my presentations, how many people have home insurance? Everyone raises their hand. When I ask how many have had their house burned down, seldom does someone raise their hand. In reality, homes do not burn down, and the insurance is never used. But then I ask how many investors have had their stock burned down, and almost everyone raises their hand because they've had some severely negative stock experience. And seldom does anyone have their stock insured. The point is, a stock decline is much more frequent and much more risky than a house fire, but they have not insured the stock. There's something wrong with this picture. It makes absolutely no sense. Let us continue with this home insurance analogy. Put insurance is like home insurance, and it has a minimum deductible based on the strike price of the put relative to the the stock price. Selecting the put strike price determines the amount of insurance, the deductible, and ultimately the financial risk of this in the event of a stock decline. And the longer the term of insurance, the less it costs per month. However, put insurance on a stock gives much wider coverage than home or car insurance. Let's examine what I mean by wider coverage. Basic home insurance generally is used for damage from fire. But what about damage from floods, earthquakes, a mudslide, and so on? Such damage generally requires a special rider and extra fees. One needs to be very careful about what is really covered. Put insurance covers the price of the stock. It does not matter the cause of the price decline. Poor management, aggressive competition, plant damage by an earthquake are all covered if the price of the stock declines. And with put insurance, there is no argument with an adjuster on the severity of the damage. So exactly how does this put insurance work? We will continue to use the Apple example in this discussion also. Assume we bought 100 shares of Apple and want to insure this position against loss in this uncertain market environment. We would buy an Apple put at the same time we buy the Apple stock. Buying the put guarantees the sale price of the stock for a period of time. But which put should we buy? There are two basic factors to determine the put to purchase. The first is the expiration date, which is based on the length of time you expect to hold the stock. If it is a short term or a long term holding. But remember, the cost per month of the insurance is less if we opt for a longer time frame. Also, the longer the time frame gives us more opportunity to apply income techniques to the position before our insurance policy expires. The second factor is strike price. As mentioned before, selecting the put strike price determines the amount of insurance, the deductible, and ultimately the financial risk in the event of a stock decline. We can create a table of different strike prices, to compare their effect. On the left-hand side of this slide are a number of strike price values, which range from $120 at the top to $80 at the bottom. The strike price represents our sale price guaranteed for the Apple stock. Remember, the price of Apple stock was $93.70 that was purchased, and we used an expiration date that was 1 year out in time. Therefore, the choice of puts ranges above to below the current price of the stock. The second column is called net debit and represents the purchase cost of the stock and the option. Notice, the higher the strike price guarantee, the more expensive the purchase price will be. The third column is the percent maximum risk, and the last column is the risk expressed in the form of points. These two risk numbers are coincidentally fairly close in value since our Apple stock is near 100. The choice of strike price is generally determined by the percent max risk, which in this case ranges from 3.1% to 20%. Most investors would not risk 20%, and most would favor the lowest risk possible. But with no risk, there is no reward. What are the chances of Apple going over 120 during our holding period? Probably not very high. The $100 strike price is a good compromise on the risk reward and will be used in this example. The 8.6% risk is calculated from a 5-line setup. This 5-line setup shows the purchase of our Apple stock at $93.70 and the purchase of a put at $15.65 for a total invested or net debit of $109.35. Since we have a guaranteed sale price of $100, our risk is the difference between the guaranteed price and the total invested, which in this case is $9.35 per share, or the 8.6%. The profit loss curve can be created for this Apple stock position with a protective put. This profit loss curve is called a married put curve. The standard hockey stick curve shows we make a profit when Apple goes above the $100 per share, and we lose up to $935 or 8.6% of our investment if the price is under $100, or even if it goes to zero. If our Apple stock is unchanged for the year, we'll have a loss of $935, the cost of the insurance. But there is more to this story. Maybe we can earn some option income to help pay for the insurance. We have established a hedged protective position that has a limited loss but unlimited upside potential. From this secure position, we can collect dividends on the stock, we can write covered calls for income, and all of these things will help pay for the insurance. Remember earlier we showed how to rent our stock out with a covered call. We collected $315 for a 1-month covered call. But we have our Apple stock insured for the next 11 months. So we have avoided one principal problem with a covered call by limiting the potential loss due to a stock decline. Since our risk is 9.15 points, writing 3 such covered calls over the next 11 months would pay for the cost of the insurance. Therefore, our risk would have been reduced to 0, and we would have bulletproofed this position. After 3 writes, the stock could collapse, and we would have guaranteed sale price of $100 that did not cost anything. We cannot lose. Now, is that exciting or what? Power Options has developed a married put manual called the Blueprint that outlines this methodology and 12 other techniques to earn income toward bulletproofing. In conclusion, this is what you should have learned. The basic definition of a put and a call, how puts and calls can be used to speculate, earn income, and how to hedge and protect a portfolio. The hedging techniques, with the use of married puts, should have completely changed your thinking about your stock investments and provided you with a path to invest for yourself with confidence and safety. Let me just share a personal experience with you about how the use of married put hedging techniques changed my investing approach. In 2001, during the internet tech crash, most of my retirement funds were invested in mutual funds as part of a 401k account. The mutual funds were diversified in hundreds of companies to provide the protection from a company-related event. The theory was that if you had hundreds of stocks, a bad event with any one of them would result in a less than 1% change to the holdings. However, systemic declines like a recession or tech collapse affect every company, the best companies, even companies with great earnings and growth, even companies with good dividends. Everything just declines. The truth is, the mutual fund diversification did not protect my portfolio, which was ultimately down 40 to 50%. This loss was devastating to my assets, which were concentrated in stock mutual funds. My stocks outside of the mutual fund did as poorly, and the covered call income paled in comparison to the market losses. However, between 2001 and 2007, I learned about the use of married puts and started to apply the concept, just in time to prepare myself for the next decline, which was to occur with the financial crisis of 2008. 2007, I purchased 1,000 shares of Hewlett-Packard stock at a little over $50 per share. However, this time, the purchase was made with a married put to insure the position. 10 put contracts with a $55 strike price were purchased for insurance. HP stock held steady for several months, but then got caught up in the 2008 market decline. Despite having great earnings, HP sank to a low of $25 a share by March of 2009. At any point during the 2-year holding period, the position was never at risk for more than 7%, and not anywhere near the eventual 50% loss possible. However, by applying income techniques and managing the puts as outlined in the blueprint, this position was actually made profitable. The bottom line result is that HP never got back to the original purchase price, but was sold for an 11% profit when the market was down 33% at the time. 11% is not a great return for 2 years, but remember, HP was down 50% at the low and never hit $50 a share again. My stock portfolio now consists of 6 to 10 married put positions and is insured to have a maximum loss of no more than 6 to 8%. With only 10 positions rather than hundreds supported by a mutual fund, it is easy to keep track of the stocks. And since each is individually insured, the loss of any one still does not affect the overall portfolio value by more than 1%. A systemic decline that affects every stock can never hurt the portfolio by more than 6 to 8%, as opposed to the possibility of a 50% decline. Another important advantage of a smaller portfolio size, other than ease of management, is the result if one of the stocks were to double. The mutual fund with 100 stocks will go up 1% if one of the stocks doubles. But if the portfolio had only 10 stocks and one stock doubles, the entire portfolio value will go up 10%. The smaller portfolio has the opportunity to outperform the market. So not only do I sleep better, knowing that my portfolio is protected from systemic or any other kind of decline, it is easier to manage and has potentially higher returns. This married put methodology has truly changed my investing life, and hopefully yours also. If you have any questions, need help, or want to learn more about these techniques, just visit our site at powerup.com or send us an email at support@powerup.com.